Good morning, folks, and welcome to the Rahul Nair Finance Show. You're listening to the Daily Deal Room, from startups to stock markets, where we decode the business buzz of the day, crisp, clear, and to the point.
And before we jump in, you know the drill. Just a quick disclaimer, this content is for educational purposes only, and it's definitely not financial advice. You should always chat with a financial advisor before making any investment decisions. Okay, let's get into it.
So what have we got on the docket today? Well, we're talking about a massive 26,000 crore rupee bet on India by a global giant. We're also going to look at a celebrity-backed brand that's kinda in trouble, with losses piling up even after a huge marketing spend. And we'll unpack India's really ambitious new plan to build our own ships and, yes, our own chips.
All right, so to set the scene, let's take a quick look at the markets and just, get a feel for the general mood out there. And wow, it was a sea of red across the board on September 24th. I mean, look at this. Both the Indian and the US markets took a hit. The NIFTY 50, the Sensex, both down over 0.5%. So it's definitely a cautious vibe, and that's the perfect backdrop for our top stories today. Now let's get to our major corporate moves. And really, it's a tale of two extremes today. We've got billions of rupees pouring in one direction and millions just draining away in another. Okay, first up, and this is a huge vote of confidence in the Indian consumer. Get this. 3 of Coca-Cola's biggest bottlers are pouring a staggering 25,760 crore rupees into India's food processing sector. This is, without a doubt, one of the biggest foreign direct investment commitments the industry has ever seen. Just massive. And the scale here is just mind-boggling. This isn't a small project. This investment is going to spread across 9 states. We're talking about creating over 300,000 jobs, direct and indirect, by 2030. So this move isn't just about selling more Coke, it's about embedding India deep into their global supply chain, solidifying its place as a top 5 market for them.
But, like I said, it's a tale of two cities in corporate India right now. While Coke is going all in, a very well-known fashion brand, backed by Virat Kohli no less, is facing some pretty serious financial headwinds.
So let's look at the numbers for WROGN, and yikes, it is not a pretty picture. Revenue is down, again, by another 9% this year, but at the same time, their expenses are just ballooning, which means their net losses shot up by a third. The brand is now sitting on a pile of over 700 crore rupees in accumulated losses. Now here is where it gets really interesting. Look at this disconnect. To try and fix that sliding revenue, WROGN jacked up its ad spend by a massive 63%. But what happened? Revenue still dropped by 9%. It is the classic definition of spending more to get less, and it just screams that there's a mismatch between their strategy and what shoppers actually want today. And all of this is happening while a new wave of what we call challenger brands, think Snitch and Rare Rabbit, are just eating up market share. See, while RBI has been relying so heavily on Virat Kohli's star power, these newer online-first brands are winning. They're faster with their designs, they're smarter with their pricing, and their social media game is just on another level, really connecting with Gen Z and millennial buyers. Okay, so let's zoom out from these individual company stories for a second and look at the bigger picture, India's economic strategy. The government is making 2 absolutely massive pushes in 2 critical industries. We're talking about shipbuilding and semiconductors. First, shipbuilding. The government is injecting almost 70,000 crore rupees into this industry, and the goal? It's nothing short of transformational. The plan is to become a top 5 global player by 2047, create millions of jobs, and, this is the crucial part, finally end our heavy reliance on foreign ships. All right, the second big play is in semiconductors, chips. And the strategy here is pretty smart. It's not about starting from scratch. It's a 4-step plan. First, play to our strengths, which is chip design. 20% of the world's design engineers are already here. Second, build up capacity in assembly, testing, and packaging. That's ATMP. Third, go for the holy grail. Attract actual wafer fabrication plants. And fourth, make the states compete like crazy with the best incentives to land these projects. But, let's be realistic here. This is a steep climb. The whole plan really depends on foreign technology. These projects take years to get going. And for now, we're starting with the older, mature chips, not the cutting-edge stuff you see in the latest phones. So the real test is going to be turning these ambitious PowerPoints into actual functioning factories.
Okay, so from these big national strategies, let's look at what's happening globally and then bring it right back home to a new rule that's going to affect how we all spend our money every single day. Over in the US, the economy's looking pretty strong, growing at almost 4%. But for Indians looking to work or study there, some storm clouds might be gathering. There's a proposed six-figure fee for H-1B visas, which could definitely slow down tech hiring, and student arrivals have already dropped to a 4-year low. And speaking of back home, the RBI is making a pretty significant change to digital payments. They've issued brand new rules for how transactions are authenticated. Mark your calendars. This kicks in from April 1st, 2026, and it applies to everyone. Banks, fintech apps, you name it. And this really shows the shift in thinking. We're moving away from relying almost completely on those SMS OTPs we all know. The new rule says you need at least 2 factors of authentication. So that opens the door for way more biometrics, like your fingerprint, device-based tokens, or secure passphrases. The bottom line, your digital wallet is about to get a whole lot more secure. From our digital wallets, let's switch gears to a very physical asset class that is seeing absolutely explosive growth right now, and that is luxury real estate. The trend here is just undeniable. Check this out. Between 2021 and 2025, the average price of an apartment in India shot up by a whopping 87%. But here's the kicker. The average size of those apartments, it only grew by 15%. So what does that tell you? It means we're not just paying for square footage anymore. We are paying a massive premium for the location, the brand, and the lifestyle. And some of these numbers are just wild. The rally was really led by the NCR region. Gurgaon prices skyrocketed by 166%, Greater Noida up 163%. Mumbai is still the most expensive market, up 107%, and tech hubs like Bangalore also saw prices more than double. This is all fueled by wealth from the IT and startup world. It's creating a whole new asset class for sure, but man, it's also putting a major squeeze on affordability for the middle class. All right, to wrap things up, let's follow the money with a quick look at where capital is flowing right now. And the deals just keep on coming. Hindustan copper is surging thanks to high commodity prices. In the startup world, Distill, a specialty chemicals firm, just raised over $7 million. And Kiwi, a virtual credit card company, secured $24 million. The money is definitely still moving. That wraps up today's episode of the Rahul Nair Finance Show, brought to you under our daily series, The Daily Deal Room, from startups to stock markets. If you liked this episode, don't forget to like, subscribe, and share with your friends, colleagues, or anyone who's into business and investing. We'll catch you tomorrow with more updates. Until then, stay curious, stay invested.